I spent so much time on trying to raise money that it actually impacted the company. So in the end, I just said, okay, now I'm just going to focus on business. I'm going to focus on sales. I'm going to sort of try and just be the master of our own destiny and growth.
You're right. It's a massive investment in time from the CEO. Sometimes it can take over, and then you're right. You're not actually growing the business, which is the thing that could mean you don't need to raise. And so often people go straight into I've got an idea, I've got a business, I've got an idea. I'm going to go and raise venture capital money. And there's so much attention on businesses that go down the venture capital route and raise money. And I think traditional businesses that actually sell something to customers that customers really like, and they make money and they create jobs and they give customers a great experience. That's the majority of small businesses out there, to be honest, the majority of startups. So I agree with you, Lynn. I think I personally think it's a better way that you've done this by bootstrapping. Hi, welcome to #Value, the show where we fix the formula behind founder finance. I'm Graham Davies, the fractional CFO and founder of Edition Finance. Today, I'm joined by Lena Andersson, founder of Go Running Tools. Really exciting business and looking forward to this conversation. Lena, thanks so much for joining us. Could you give us a quick 60-second breakdown? What your company does, who you serve, what problem you're solving, etc., just so we can get an understanding of your business.
Yeah, absolutely. And thank you, Graham, for having me. My name is Lena. I'm the founder of Go Running Tours. And basically what we do is that we do in-person guided running tours in, I think now, 80 cities around the world. And basically what it means is that if you're a runner and you're traveling and you would like to go for a run and see the city and meet a local, of course, be safe, make sure that you don't take any wrong turns, then you book a running tour with us. And one of my colleagues will run with you in that city and show them the city. And that's also something that we do in connection with conferences and events and meetings.
I love it. And I obviously done quite a bit of research before and noticed that you were in some really, really interesting cities, actually. A lot of cities around the world, which is great. So,
do you run, Graham?
Yeah. I try, but I'm not very good at it, and not very often, unfortunately. No, I'm more of a weights person. But yeah, I do. Okay. I should join one day, definitely. Obviously, it's all over the world, so that would be a massive cost base if you had employees in every city and all over the world running these tours. How do you run that operationally?
Well, so basically what we do, we of course have the central operation, and then we have guides that work on, they have regular jobs, we call our job the real job, and then there's sort of Deloitte consultants on the side and so on. So they have regular jobs, and then they also do the running tours. Yeah.
Oh, fantastic. Yeah, really, really great to see. Great business. I really like it. Few questions for you then to get into. Lena, first one, could we go through just your journey, when you started it, and what that journey has looked like for you to today? You know, has it been this, like, you know, in startups and when people start a business, often people just think like it goes like this, straight line up, like this up. Has it been like that, or has it been sort of up and down? How's the journey been?
I think if I have to draw it, it was like really slow in the beginning, and then it started going up, and I was thinking, okay, here we go, here's the hockey stick, and then tanked totally because of COVID. And then it's coming up. I mean, we're growing quite reasonable at the moment. So it definitely hasn't just been this straight curve or this sort of a hockey stick in any way.
Great.
But we are sort of seeing growth, and we're seeing the right growth patterns.
When did you launch again? Which year did you launch?
So I started the tours in Copenhagen. Initially, I just started tours in Copenhagen in 2011, and then Go Running Tours started in 2013.
Okay, wow. So you've had a lot of history, which means you are definitely an established business now. You know, you've gone in theory beyond that sort of point of most startups fail in the first 5 years sort of thing. You're well beyond that now.
Maybe we'll fail in the first 15 years. Let's see. But yeah, it's a little bit slow going. I think it's also, I mean, we don't have investment or anything, so it's also been organic growth. I think a lot of startups, they get investment, then it's sort of, I wouldn't say it blows up, but then you sort of truly kickstart it. And then of course there's different risks and so on.
Yeah, of course. Yeah, an interesting point that you mentioned. You haven't raised any external capital at all. Was that intentional, Lena, or was that just how it's worked out, or What would you mind talking through your thought process on that?
Yeah,
'Cause it's
yeah,
obviously a big
absolutely.
one for our listeners.
Yeah, yeah, absolutely. Well, I think first it was by failure and then it was by choice. So when I started the business, in the beginning when you start in Copenhagen, it was just like, okay, this is what I'll do. This will be fun. I
Yeah,
quit my regular job and then I started doing the running tours. And then as the global company started to grow, I tried to get investment a little bit, tried to raise some money. Um, but it didn't really work. And a lot of times I would speak to these angels and so on, they'd say, oh, come back when you have that. And then I came back when I had that. They were like, no, 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 come back when you have this. So there's a lot of going back and forth. And of course, also, I think our business is a little bit different. No one else had done this before. No one really has done it. It's not a lot of the startup environments are very tech based. So I think also the investors sort of saw it a little bit more sort of more complicated, a little bit more slow going, couldn't scale in the same way, and the usual sort of methods. So that was part of it. I tried. I was actually during COVID. I was actually invited to be part of the Danish version of Dragon's Den. And initially I said yes. I was like, when they called me, they were like, I was like, no, I'm in the middle of a global pandemic and our sales is absolutely zero. And they were like, no, no, you should still do it. So I did it. I didn't get the investment. Admittedly, I also went in with a high valuation, also based on the numbers and how they looked. But I'd sort
okay,
of already made the decision that I wouldn't go in and sell a significant part of the company for that, especially not in that situation, because I didn't really feel it was we were in a the most constructive sort of situation at the time. So and then after COVID, I joined some accelerators, went out, tried to get some investment, and it didn't really work. And I don't actually have the correct formula why didn't it work. Sometimes it was
yeah,
like, oh, you don't have a co-founder, you should have a co-founder. You don't have this, then you should have this. And in the end, I was a bit I had a few offers, but it wasn't really with the right people. I think I didn't feel right. So in the end, I decided I spent so much time on trying to raise money that it actually impacted the company. So in the end, I just said, okay, now I'm just going to focus on business. I'm going to focus on sales, and then if an interested investor comes in, then that's fine. But it's not something I'm going to pursue. I'm going to sort of try and just be the master of our own sort of destiny and growth. And whether that's right or wrong, I don't know. I'm sure it would have. I mean, sometimes I also wish, Graham, I had millions to throw into tech and into
yeah.
advertising and events and so on. And other times, I'm pretty happy where we are. We have a stable business. We don't really have that risk. We're growing. I don't know.
It's interesting,
There's
isn't it?
pros
And
and
it's an
cons.
interesting conversation because obviously it sounds like it was it was a big project to try and raise some
Hmm.
money for the business.
Yeah.
And you didn't give up actually, which was amazing. Lots of founders, I think, would give up at that point and say, actually, I can't get this off the ground, so I'm gonna leave it. The fact you did
But
it anyway in a bootstrap fashion, I think, is really, really impressive.
Oh, thanks, Graham. But I think also for me, it really is the best job in the world, and I think what we're doing is
Yeah,
the most fun thing, and so it's also more passion project, right? And it's sort of like I don't sort of if things don't really go that well, or if something fails and so on, I never sort of think, "Pff, sod it."
yeah,
I'm always like, all right, that didn't work. Let's figure something else out. It never occurs to me, sort of really sort of thinking, well, this isn't going to work, or this is not what I want to spend my time on, or these are not the people I want to spend my time with.
yeah. That's it. That's the life of a founder, isn't it? Always solving problems, basically.
Yeah,
Something one comes up every day. They've always got something to solve.
absolutely.
Uh, but you're right, it's a massive investment in time from the CEO as well to
Mhm.
fundraise. Sometimes it can take over, and then you're right, you're not actually growing the business, which is the thing that could mean you don't need to raise. And so often I think people go straight into I've got an idea, I've got a business, I've got an idea, I'm going to go and raise venture capital money, and it rarely works out. And I also think you don't necessarily need to so early. I think you can just get out there, build the business, get the business going, prove that customers want to buy what you're selling, and you're solving a problem for them. And then later, they come knocking on your door often, to be honest with you.
Well, I'll also be honest, that hasn't happened yet. But
And there's
maybe
always
it will.
time. Yeah.
But I think also, and this is also probably maybe it's just me, but I'm also sort of, for me, it's super important that it's the right people, right? So I'm not just looking for money and so on. I want someone who really gets it, who is just as excited about running with people in Buenos Aires and in Hanoi and in Stockholm as I am. I get just as excited about the updates on Slack, and it's not so much. And I probably shouldn't say this on a podcast like this, but it's actually not that much about the money. It's more about doing something that creates, that's just a lot of fun for everyone. That's healthy. That somehow bridges cultures and understanding, and there's just different things to it. And so it's also important for me, if I was going to have a partner in the company, an investor, it would be someone where that would be the number one thing. And then we have this agreement that we will build a proper business and get some return on investment.
Yeah. So your primary aim is to build a business that you want to run. You enjoy running. You know you want to play on words there, running a business. But anyway, you enjoy a business you want to run, and that's the first thing that you want to work on this mission, I suppose, rather than. And I guess you have bills you need to pay as well, so you need to make enough money. But if you're not necessarily doing this to be the next Elon Musk, I guess, right? Or Bill Gates or whatever. You're not doing it for the money. Is that right, Lena?
Yeah, I think that's a good way of looking at it. Well, I mean, I still want to build a healthy business, but I don't have to earn the last penny and so on. I would like to do it in a way where it feels comfortable for everyone in the company, and also that it feels good for the guests and for us.
Which I think is amazing, because the media spends so much time. There's so much attention on businesses that go down the venture capital route and raise money, etc., to build their business. But it's such a small percentage of the businesses out there. And I think, good sort of traditional businesses that actually sell something to customers that customers really like, and they make money and they create jobs and they give customers a great experience. Those guys don't get the coverage. And I think that's the majority of small businesses out there, to be honest, the majority of startups. So I agree with you there. I think I personally think it's a better way that you've done this, but by bootstrapping. That's just my personal opinion. But you don't have a boss, do you? No one to answer to apart from yourself. So that's always nice.
But that can be a hard person to live up to the expectations sometimes as well, right?
That's it. Yeah, exactly. Yeah, they're the worst, the hardest boss in the world.
Exactly. No, but you're right. But I do think the cases with the venture capital and so on, they do serve a purpose, even for founders like me, that you do have some aspiration. You can see, okay, this is how they do it, this is how they measure things, this is how they get traction. And it's interesting to see what happens when people get millions. How do they use them? Can we replicate some of that? And then, of course, also you can look at the other side of it. Why do some of these almost identical companies that has raised the same amount of money, why does one do really well and why does the other one tank, right? I don't know, there's a lot of learnings to it.
Yeah, no, definitely. And I think, well, we could spend the whole podcast talking about that, couldn't we? But some people, I think I guess lots of companies raise, then they think, okay, I've done that, that's it now, I've got the money, now I just have to spend it and the business will happen. But actually that's the hardest part, really, is now taking that capital and making sure that it's actually going to deliver the growth.
Yeah.
And deliver the plan that you sort of outlined on paper, because we know nothing ever goes to plan, does it? So, and bootstrapping gives you that ability to be able to just, that isn't quite working, on a limited budget, so I've got to tweak something and change something to make it work. And it just makes you, it sharpens you a lot, that you have to focus on all of the metrics and all of the things that matter for your business. On that point, actually, Lena, what is the one, maybe you've got more, but what's the main or the one financial metric that you track regularly, and why do you track that one?
I track, well, there's a couple, of course, track number of bookings. I track revenue, and I do that month compared to the same month last year because of the seasonality, and then of course margin as well. So those are really the three main metrics. I think probably one that I should be measuring a lot more is which is actually much more valuable sometimes. I think if we sort of look away from the actual money in the bank, is number of bookings per client. So we have guests who's run with us 26 times, and I think that's a great example of, okay, can we keep adding to all the new clients that come in? Will they keep running with us? Is it the same uptake through all these years? So are we just as good now as we were 8 years ago? And so can we do this at scale with all these cities? And sort of maybe plan a little bit more based on that, but I don't know. It's something I spend a lot of time looking at as well.
That's good though. So you've got some of your customers have run with you 26 times.
Yeah, and I think even more now. This was when I just did the calculation before Christmas. Yeah.
Wow, fantastic. Okay, so but the main metrics you're tracking regularly are gross margin, revenue, and bookings. Those three really, I guess. And do you look at that every month or every week or daily, or how does that usually work for you then? What's that
every day?
Like? Every day.
I'm such a number nerd. Every day.
Every day,
and sometimes twice a day. Even though I know, okay, nothing has come in, I'm just gonna look at it and just see. Okay, we should be a little bit higher. Okay, now we are 36.3% below compared to last month. There's 11 days left. What does it look like? And but I think it's also just this. I'm pretty competitive, so I think it's just this internal competition with the month before, right?
Yes.
Or the same month last year.
It's interesting, isn't it, that we have that competitive element. Yeah, I'm the same as you, to be honest with you. Even though I know what it's going to say, I'll just check the metrics again. It's a habit, It's a bit like checking your emails all the time. It becomes like that, doesn't it? But I think that's a really good. Okay, maybe we don't need to check twice a day, but anyway, it's a really good habit to have, I think, being on top of your numbers and the metrics in your business. And I think that probably speaks to a lot of the success that you're still here now after, a good few years then, and without raising money. And I think you wouldn't be able to do that if you weren't looking at your metrics and running the business like that. So that's fantastic to hear, actually. I really love it when a founder's looking at their metrics.
Good.
Yeah. And what would you normally do? Let's just say, like, you looked at the metrics for last month and you were down 11% or something on last month. Do you do anything with that? Do you take any action? Do you
totally? Yeah. Totally. I mean, I wouldn't say I panic, but I go into first one is like, why the hell is this happening, right? What is not working, what's working, and what are we going to do about it? And I'm also every month I have global team calls where all the guides call in, and I always share the numbers. I'm super transparent, saying, okay, this month we are this many percentage above the same month last year, but the numbers look like this, and we can see this is happening. Yeah. And I just say this is a red flag, and then I always have a slide. What are we doing about it? And sometimes it's it's really deep diving into, okay, why is our organic growth declining? Why, or sort of our organic not growth, sorry, website visitors, why is it declining? And that's, especially here in the spring, I'm not an SEO expert. I spent a lot of time, invested a lot in it, but now you have AI coming in, right? And all the search results in Google now are sort of, people don't go to the website anymore, they just get the results straight away. You can also see, if you search for what to do in Venice, you get a lot of ads, you get all these things, and these are big players that we don't really have the budgets either, right? So that sort of these external factors, I spend a lot of time trying to understand, and then also trying to build other channels where we are not so depending, or at least where we can control a little bit more what we do. And then also sometimes we just also have to accept that, for example, when there's big waves sort of in the world, like February was a super turbulent month, I think, for everyone. Stocks were all over the place. There was a lot of uncertainty. There was a little bit of there was a little bit back and forth between Europe and the US, which is our biggest markets and biggest economies. So sometimes, and this is what COVID taught me as well, is like sometimes you also just have to say, okay, it is what it is, and we keep going at doing what we do. So some things we can change, some things we can't.
Yes. Yeah. Okay. Good. So, but you are looking at it and you're taking some action. You're doing things based on the
Yeah,
metrics.
yeah, and also I also sometimes make, I don't know whether it's wise or unwise. So for example, when the numbers decline quite significantly in the spring,
Yeah.
I just, even though our cost of acquisition is pretty high on digital advertising, we invested more there because it was like we need to keep the bookings
Yes.
going. So it might not be the most sort of financially optimal way that we do it, but at least it's considered, saying, okay, now we're gonna pay a lot more money for a booking, but we need to sort of get this going again.
But that's a conscious decision, isn't it? To
Yeah,
say we're happy to we're happy to invest a bit more in acquiring a customer.
yeah,
Than maybe with that, but that's great. Rather than it being too late and saying, "Oh wow, it was more expensive to get those customers this time around." You actually
yeah,
chosen to do that, which I think is great.
yeah.
And you still look at it in the round, I guess, that it's still worth it for that customer to spend more acquiring that customer because you're still making more money than you spent on getting that customer, I guess.
Not always. I mean,
Not always.
sometimes we lose money on a booking, but I think there's, well, at least for the first booking, right? Of course, it always depends how many people, what kind of tour do they book, and but the most important thing is, will they book with us again? So we don't. It's not always sort of, but that's a conscious decision as well, saying, okay, now we pay very high for the first booking, but there's also more to it for me, Graham, because one thing is that we get the clients and we get the guests, but it's also a matter of making sure that our colleagues around the world get enough bookings, so they don't just suddenly don't have any bookings. So really, what's the value of a booking? It's not only the amount of money we get in, it's also the fact that the guides go out, they get a they have a great tour, the guests start talking about what they've done, that goes on social media. So there's all these add-on effects.
Starts to build the business then longer term. Yeah.
Yeah, I don't really have a number for that. The add-on effects.
That's interesting though. Yeah. No, because that's where finance and marketing, I guess, sometimes can just be in a little bit of conflict there, because if you look at it financially, you might say, well, actually, we don't want to spend more to acquire a customer than what they're worth to us. That's bad. But on the other hand, the other angle is, well, actually, we've got someone in the city. We're trying to build that city, and we're trying to build awareness. We want those customers to go so they can tell their friends about it, and like you said, talk about the run on social media, etc., which will have a bigger long-term effect on the business. So it's like an investment. It's an investment in growth, isn't it? And I think a lot of the time, less pragmatic finance leaders might just say, why would you spend more to acquire a customer that's worth bad business? But for the long run, in that case, it definitely makes sense, doesn't it? Well, we hope it makes sense. It might not always, but it's a risk you take. It's a risk you take, isn't it?
And as long as you're aware of it. But I actually must admit, I make many decisions, not just on numbers, but just like what feels right. What make or is it fun? Is it something we'll really enjoy? It might makes no financial sense, but will this just be super fun to do? And then we do it as well.
Okay, fantastic. Yeah. Okay, perfect. Now, thanks for sharing that around the metrics. I really appreciate that. I have one more sort of question on the tools that you use to manage your finances at the moment. How does that look, Lena? What sort of like tech stack do you have, operationally to run your finance department? What setup have you got there? It sounds like you've got a good one because you've got the information daily.
Well, I think you might have a heart attack now, Graham, because it's really not, tech stack sounds so flash, and so it's basic. It's so basic what we do.
Even if it's Excel, that's the part of a tech stack. That's fine.
Okay, yeah. So basically, we of course I look at the gateways, so how where the money that comes through our website or credit card payments and so on.
Yes.
So we use Stripe there, which I think is pretty standard. Then in terms of bank accounts, we use Wise. Which works well because we can have accounts in different currencies. Yes, and then in terms of sort of the bookkeeping and so on, we use a Danish system called, I think it's Danish. It's awful, but every time I speak to a Danish accountant, all they want to do is work with this. And I was like, can we use something else? What about Xbooks or Inuit or whatever it's called? But this is what they really like. It's called economics. And I am not a big fan. I find it really old fashioned. I can't. I just can't. The fact that I can't import, an Excel and get all my invoices in, it just drives me mad. But my superstar accountant loves it, and I think it's a little bit. I think your accountant is a little bit like your partner, right? You have to keep them happy, because then your own life is a little bit happy or a little bit easier.
Yeah, you get what you mean,
that we use that, and then in terms of sort of keeping track of profitability per city, profitability per tour, then I use actually just Looker, Google Looker based on Excel, and also my cash flow I manage just simply via macros in Google Sheets. I use Google Sheets.
Yeah. But it sounds like you have experience of that. You mentioned macros in Excel, so you've obviously got some experience of, before, when you had, like you said, a job before this. I guess it was in sort of business before that?
So I used to be sort of in strategy and marketing.
Okay.
And I really like spreadsheets. So I've sort of I really like logic. So that's sort of where it comes from.
There's a lot of things that I think tech is really good for. Automation, automating sort of regular tasks and making things very straightforward from a labor point of view. Perfect. This is the last one, and then I'll then over to you to ask me any questions you have from the finance point of view. Are there any financial decisions that you regret so far in the business that you think, what, we did that and I wish we didn't?
Yes.
What did you learn from it?
Well, I can tell you the biggest, I don't know whether I regret it. It's not like, oh, I wish I'd done that. But I do think, what would it have looked like if we had done it in a really fun way? Because when we first started the business, we were actually two founders. Later on, it's just been me. But when we started it, when Stripe, these were the earliest stages of Stripe, you could actually collect payments in crypto, in Bitcoin. And I was like, we should do this. And not everyone agreed. And that was too much risk. And we didn't really know what it was. And I was like, doesn't matter how many people are going to use it. Let's just do it. Let's just offer it as a solution to do it, right?
We
never did it. But I'm thinking now, 13 years down the line, imagine if we had done that, right? Dude. Imagine how different it would have been.
Because that was the beginning-ish, wasn't it?
Exactly.
It would have been,
exactly.
Well, you'd been dialing in from the beach somewhere.
And I think I would still be working in this company, but I think it would just be, I don't know, it would have just been hilarious, because it would also have been a little bit random and I like when good things happen to people just because they thought it would be good or it would be fun to do something. But that didn't happen to us.
Exactly. Well, don't lose any sleep over that one. There's lots of people that didn't do that back in the day. Yeah. Anyway, thanks for sharing that. Do you have any questions for me? Anything I can help you with your business?
Well, I think there's a couple of sort of things, and so we talked a little bit, what does the tech stack look like and so on. There's a couple of things that I don't know whether I'm doing it right, but I would love to get a little bit of input for it. One thing is that we, of course, sort of, we have a lot of liquidity because people pay in advance for their tours. Which means that we have the money, and then after the tour, we of course pay out to our colleagues out in the world. And one thing that I'm always thinking about is there sort of, we get sort of cash back in our Wise accounts and so on, but it's minimal. I'm sort of thinking, is there a better way of managing this money? It can't be high risk because I need the money when we need to pay it out. But sometimes, we have sums just standing there. So it's also like, how do you manage this liquidity, and what's the best way to do it to make sure maybe you can also capitalize on what's on your bank account? Yeah,
it's a good question, isn't it? I think you mentioned you use Wise, and I know you're in Europe, but in the UK and in the US actually, they launched this thing. There's a partnership, I think, with BlackRock or something, where you could tie it up in an investment account, and it was tied to base rate. So I think in the US at some point we were getting like 5% or something on US dollars, and similar rate in the UK. You have that set up already, then? Have you set up that investment account in Wise? Because that's better than their standard just cashback.
Cashback. I haven't, because whenever it's said, and I'll be honest and say I was a little bit in a rush when it comes up on your account, it
Yeah.
says there's some risk associated with it. So
Okay.
I never really got into it saying, okay, does this mean I put
Yes.
my money into a high risk stock account, and then we never really know how it's going to look in 3 months time. So it's more
Yeah,
when
sure.
they
You want
offer
something
this,
no
I don't.
risk. Yeah.
Yeah, well, yes, actually. So I guess I don't think that's probably possible, but I guess my
Yeah.
question is, Graham, I don't know whether you know, would that be a good option if a bank offers something like this, saying, okay, we can offer you 5%, but I mean,
Usually, I'd say yes. Obviously, even money in a bank account is not risk. It's not completely free of risk, as we know. Like banks do go bust and they go bankrupt. But I think if you look at the history of Europe, and I think the US as well, um, I don't think there's been a bankruptcy that hasn't ended up being bailed out by a government in some way, and people end up getting their money back anyway. So I think that makes it quite low risk from that point of view, in that actually no one's ever said, "Oh, I lost all my money because I had it in a bank account and the bank went bust
no.
and I've lost my money." So that's never happened. So the precedent for that is very low risk. So I do think that would be a relatively low risk investment if a bank offers you, say, a fixed term investment or something. Now, they often
Okay.
offer you things like, hey, if you tie up this amount of cash for 6 months, we'll give you X percentage and stuff. That's the lowest risk stuff. Now, obviously, the returns there don't really they don't excite you, do they? Let's be honest. It's only a few percent, 3 or 4% or something. It's not amazing. It's not amazing, but especially when inflation has been running
Yeah,
very high.
exactly.
But you're kind of losing money. But there's that, which is the lowest risk. We should definitely, if you've got a surplus, do something like that because it's free money basically.
Yeah.
And the other thing, I guess, is this is obviously difficult, but there must be a way of investing it in ROI in your business. But that's much higher risk, right? So investing that in faster growth or more growth or better quality growth in your business, that's going to give you a much better return longer term. But the
Yeah.
other question that comes up for me is that money customer money until they run, i.e., are they due a refund? So should we not really do anything with that cash?
Yeah, they always do a refund. Of course, we keep it a small amount. And also, even during COVID, where we could probably have used our contracts and so on, we refunded everyone. So
Okay.
I always, this is interesting because money is never really, it has never been a motivator for me. But I
Yes.
do sort of always make sure that we have enough money to pay out at any time. If something happens, there's always enough money that we can pay everyone, the guides, the guests, and so on, without having to go out and ask for money and so on. So that's one thing. And I guess that's also the question, like, what should the risk profile
Yes.
be? Because would it be responsible to say, okay, as long as you have 70%, or I mean, I don't know if there's a calculation. I just go 100% if something happens. Also because I've been through COVID,
Yes.
I've been a bit like, we need to be able to treat our customers and our guides or colleagues as we should. But what companies like similar to mine, where there's payment up front and then you pay them out later, is there like is there a number where they say, okay, 70% we have to keep all the time, or 60, or 80, or is there some sort of rule of thumb?
It's interesting, isn't it? Actually, back in the day, I worked when I had a job. I worked for a travel company once, so one of the biggest ones actually, and we didn't. We just would reinvest the money. So
Yeah.
that all that cash that customers paid up front for a holiday, that cash ended up being invested in the business in further growth. So but they did have debt facilities in place so that if something did happen and needed to refund those customers, they would draw down on that debt facility to be able to do that. But
What can
that
you
comes with a
explain? What?
cost. Yeah.
Okay.
So
So
that would
debt
be
facility. What does that mean?
yeah. So what that basically is like that's simplest way to describe it, like an overdraft. So let's just say there's like an
Okay.
overdraft available to you, and if you needed to use it, it's there. So,
Okay.
all of the receipts from your customers, let's say you did invest in it, I would not say is responsible to do, to be honest. I'd say the responsible thing to do is what you're doing, keeping that customer money until they've run, and then it's your money, right?
Yeah.
But if you did want to invest it, make sure there's a sort of overdraft or they're called a revolving credit facility or some kind of debt facility in place that would allow the business to be able to repay those things if it came about, if it arose that there was another COVID or some sort of disaster.
Yeah.
I don't know why Europe doesn't really have this, but in some other countries they have like if it's client money, so if it's due back to the client until they run, you can't touch it. But we don't have that in Europe, in the US, to be honest with you. It's quite fluid. That it's not really client money, is it? It's just there's a refund policy in place, so they've paid for something, but they can get refunded up to 24 hours before, is it, Lena? Or what's your refund policy?
72 hours.
72 hours. So as soon as the 72 hours is gone, it's your money, isn't it?
Yeah. Yeah. Well, we say that, but I mean, to be honest, we have very, very few cancellations. And usually if people cancel, it's because our flights didn't turn up or we have illness in the family. And then between you and I, Graham, and the world who's watching this, we usually refund anyway.
Very, very responsible business. Yeah, I love that. Yeah, you do. But why not? I think that goes a long way. That goodwill with the customers probably means they'll use you again, and they probably will tell their friends about it.
Yeah.
And that's really
this company didn't screw me over. That's
exactly.
That's a title to to cherish as well.
They actually gave them money back. Yeah. These days that is a title to cherish, isn't it? But no, I think is there a percentage? There isn't an off-the-shelf percentage, but 100% maybe is very, very risk averse and very conservative, retaining 100% of it. Now, what you probably would do if you wanted to be really scientific about this is maybe do some analysis over the last couple of years. You might need to get your Excel out for this one and look at, on average, what percentage of these people do actually cancel, and what does that look like over time? And then that will give you an answer on, okay, over the last 10 years, we've only had to refund 5%. Therefore, if we keep 10, 20% or 30%, that's more than enough.
Yeah.
That's probably the way I'd approach it.
That's a good point. And would you also weight it? So you would say, okay, the amount of money that's due in, let's say, May next year is less important than the amount that's due next month. So would you weigh the amounts per payout?
I see. So some people book that far in advance, like a year in advance, really, do they?
Yeah, I don't know who these people are. We're always like, who are these people who know when they want to run in 12 months' time?
Yeah,
but there are
crazy.
people like that.
It depends how much time you have to do the analysis, but you would do it so people that book a year in advance, how likely are they to ask for a refund at this point in time? People that book 11 months in advance, how likely are they to ask for a refund? People that book at 10 months and so on, and you work it back like that. And then you'll get a blended average of how much you should hold to cover refunds, if that makes sense. And then maybe just double it just to be safe. And then the rest of it, you could probably be safe to assume that you can go ahead and use that cash. But COVID could happen again, couldn't it? Let's be honest. But that does seem like, to plan for COVID all the time does seem a little bit risk averse, doesn't it? It seems like
absolutely.
We can't have a global pandemic at the back of our mind always and make sure we're covered for a global pandemic. It's so difficult to do. If we did that, no business would ever grow probably because they'd just hold on to all their cash. But hopefully that sort of answered the question. But some Excel work needed on that one, I think, to figure that one out. But in terms of investing it, definitely invest in those pots in those banks that offer higher interest than the standard bank account, and then really figure out a way of acquiring more customers with that cash, I guess, to turbocharge your business is probably the best way to do that. Otherwise, or if you're happy with growing how you are, because I know it's you're happy, the business as it sort of is and growing at the rate that you're growing at. If you don't necessarily want to grow so fast, then it's one of those things. Unfortunately, we've got this surplus cash. We can get some money for it, but we can't there's no magic bullet on that one unless you risk it, I suppose.
Yeah, I mean, I want to grow as fast as possible. Don't get me wrong, but I just also want to make sure that something happens. We can that we do it in a proper way, right? That it's good for that. It's in, I guess, in a safe way.
Yeah, of course. The other thing to bear in mind is you've got costs that you have to pay in the future as well on that cash, right? So you're gonna have to pay people to host the tours and things.
So I try and sort of, try and really do it a little bit tight. I have another question for you, Graham.
Yeah, please.
Then I always, in my mind, right, you say go out and invest the money in the business and so on. So I always try and actually make very little profit every year, so that everything we earn is sort of put back into the business. Is that the right thing to do?
That's a big question, isn't it? Yeah. Well, you're reinvesting any profits get reinvested in full, basically. Maybe it's hard to do it in full, isn't it? Maybe it's, I don't know, ish. But you reinvest all of your profits into growing the business.
Yeah.
I think if strategically the plan for the business is to grow faster and to maintain growth, I think that's a really sensible strategy, to be honest with you. I think that makes a lot of sense. Sometimes owners of businesses and founders have other personal needs as well. Like sometimes people want to get a mortgage or something to buy a property, etc. Maybe they want to show, a certain amount of profit that allows them to get a mortgage or a loan for a house or whatever personal needs they have. But I think my point there really is it's a very personal reason for choosing what you want to do with your profits, I suppose. But in your case, seeing as you're scaling a business and wanting to grow, reinvesting all the profits in growth makes a lot of sense. So I definitely would back that. Then it's about, are we investing in the right ways? Are we getting a ROI?
Probably not.
Are we, then it's about measuring. It's measuring that return, isn't it? Okay, well, if we didn't run at break even, i.e. invest all the profits, it would have been X amount. And what does that amount invested, what return, what kind of growth did we get for that? And assessing that. But that is the constant battle, isn't it, of a business owner and a business leader is, am I getting an ROI on this? Is it working? Is it working? And there's no perfect science for that, unfortunately. Although people do seem to suggest it's formulaic. If you invest this amount, you're going to get this, and so on. It never really works like that, does it? So it's a constant having to keep on top of it all the time. But I think if your mission personally for you, for the business, is to scale and to get more scale and to have a bigger business, reinvesting the profits in growth and developing the business makes a lot of sense. I can't argue with that one. I think that makes a lot of sense. But again, we should always have one eye on risk, shouldn't we? And risk tolerance for you as the founder, as the person running the business, and what kind of risk do you accept, and should you have a small pot of cash that you build over time to cover global shocks, recessions, pandemics, whatever. And so always have one sort of eye on that as well. So if we just reinvest everything and we've got no headroom whatsoever, then we are running in a high risk way, and we have no wriggle room if a pandemic happens, or let's say a recession or something. Whereas I think so it's always having this balance, isn't it? Reinvest profit in growth, but also having one eye on risk and mitigating those potential risks as well. Or there's a bit of headroom, a bit of cash in the business to do that. Is that what you do at the minute? It sounds like you do.
In terms of reinvesting everything?
Yeah, do you reinvest everything, or do you hold a small amount of cash just to cover?
No, well, both yes and no. I would like to reinvest everything, but sometimes I need a little bit of a buffer. So, for example, right now we are opening up trying to see if we can develop a new sales channel. And that takes time to figure out, okay, how do we fit in? What should what should our product or what should our service be? What's the implementation? So basically here I have to invest upfront. It's probably going to be 4 or 5 months before we see, does it work? And what's the return on investment? So here I sort of, during the year, save a little bit more money than just, just running it to zero all the time. So I can get someone in, we have the buffer to test this out, and then build on it. Because sometimes now I've onboarded 3 new colleagues over the last couple of months, right? And I'm certain this is how it should be, and they're doing great and so on. But we learn all the time as well, and it might be, okay, that didn't work, but we need to do it this way, and so on. Of course, we then have good people inside the business that we can change it, but it's never really that linear. So that's how I do it. So I don't just go to zero all the time. I build a buffer so we can take a leap and say, okay, now we focus on this new sales channel. We hire people to try and develop it together with me, and then hopefully it will work up. So we have this buffer to do it.
It was very thoughtful. It's on a sort of project basis. Yeah, that makes sense. It makes perfect sense. Like, okay, we'll build up a bit of cash. Now we can reinvest in this project. Did it work? Yes, no. And like you said, it isn't linear, unfortunately. It really isn't, is it? You just have to try these things. It's trial and error. Try this. Did it work? No. Okay,
Absolutely.
move on to the next thing, and so on and so on. And so, and maybe those larger businesses, actually, very large businesses, maybe it is a bit more formulated. They've got a much stronger brand presence. They're known by everyone. They know if they just turn on some ads, they're going to boost some revenue or whatever. But for smaller businesses, that's actually much more challenging to do, because you're still building that. You don't have those assets being a massive brand that can just bring in revenue for you.
No.
So I do think that's much more trial and error, and that approach that you outlined there is really, really smart.
Oh, thanks.
Like I said, that's why you're still here. That's why you're still here in running a bootstrap business after so many years, because you know how to do it. Yeah, very.
Well, you learn from mistakes as well, right?
You learn from mistakes. Yeah, that's the only way, isn't it?
Yeah.
Definitely. Cool. Any other questions for me, Lena?
I think we covered most of it.
Appreciated it, and it was fun, and it was really fascinating to hear more about your business, and great that you've managed to. Honestly, do you say 2013 you launched? It's before that, 2013.
Yeah.
12 years in. Wow. Thanks so much for the chat, Lena. It was really great. And,
Thank you.
I've really enjoyed it, and learning more about your business and how to run a bootstrap business, which I think is fantastic. And lots of founders should, I hope, learn a lot from this.
Well, I learned something at least, so thank you. The first thing I'm going to do is going to go on Wise and say, yes, give me your investment.
Exactly. Oh, God. And then, what happens? Typical, isn't it? Like the first time ever in history, Wise goes bust or something.
Yeah.
Everyone loses their money. You'll be knocking on my door. But I think that's fairly safe. You'll be good at that. And it is. It's actually a really good product. I have advised quite a lot of our customers to use that Wise partnership with BlackRock. Yeah,
it works super well for me,
really
and also it works well with for the guides as well. Before we used PayPal, and I felt like the only winner was PayPal.
Yes,
it cost us a lot of money. It cost the guides a lot of money, and Wise just tends to work really well and much cheaper as well compared to Danish banks, at least.
Yeah, I agree. Yeah, Wise is great. No, thanks for sharing, and let's keep in touch, Lena, because
absolutely,
I always like to follow businesses like yours. Are you in the UK? Do you have a presence in the UK? Or you often
we do the tours in London, and then we also have a partner up in Edinburgh.
Oh, fantastic! Yeah,
nice. Those 2 destinations.
Yeah. Well, if you're ever in London, you must let us know. Grab a coffee, but let's keep in touch.
We'll go for a run, Graham. You have to leave the weights just for one day, and then we'll go for a run.
Yeah, let's do it. Let's get the run going. Yeah,